In just 1 week, it became clear how quickly sentiment in global markets can change. The technologies that had recently driven record growth suddenly lost momentum. Artificial intelligence stopped being viewed as a sure bet, and investors began calculating risk instead of chasing dreams. Hundreds of billions of dollars disappeared from the market. Volatility increased sharply. The key question now is not whether a correction will come, but whether a deeper shift in trend has already begun. Hello, this is the Interesting World channel, where we focus on important and interesting developments from around the globe. If you enjoy our videos, please consider liking and subscribing so you do not miss the next one. While American technology stocks fluctuate, Europe is quietly gaining strength due to expectations of lower interest rates. Bond markets are sending signals of caution. The Supreme Court of the United States has intervened in trade policy. Financial technology companies are maturing, and insurance providers are responding to growing uncertainty among households. Each of these developments alone is not dramatic. Together, however, they create a new picture of the market environment. This commentary separates hard data from interpretation. It explains why markets react to changes in interest rates, how the relationship between inflation and bond yields functions, and why volatility is not only something to fear, but also an important signal. It places current developments into historical context, from the dotcom bubble to the technology correction of the year 2022. Most importantly, it asks whether we are witnessing a short episode of overheating or the beginning of a new market phase. If you want to understand what is really happening beneath the surface of stock prices, this video will provide context that you will not find in standard news coverage. In recent weeks, we have observed a significant cooling in technology stocks. The most visible correction has affected companies linked to the artificial intelligence boom. For example, Nvidia shares retreated after a steep rise and became part of a broader sell-off in high technology stocks. This sell-off increased market volatility, meaning that price fluctuations became sharper and more frequent compared to the previous period. The Financial Industry Regulatory Authority defines volatility as the degree of variation in trading prices over time. The more dramatic the price swings, the higher the level of volatility and the greater the potential risk. On Wall Street, major indices gave up part of their earlier gains. The technology-heavy Nasdaq index fell by approximately 2%, as investors reduced inflated positions in artificial intelligence-related stocks. Fear of an overheated market contributed to rising nervousness. Many artificial intelligence companies were priced for extremely optimistic growth expectations. When expectations become too ambitious, even small doubts can trigger corrections. We have seen similar developments before. In the year 2022, technology stocks declined sharply in response to tightening monetary policy. Earlier in the year 2000, the dot-com bubble burst after a period of excessive speculation. Market history repeatedly shows that rapid growth is often followed by corrections and higher volatility before prices stabilize at more sustainable levels. The reassessment of technology valuations is now resonating throughout the global economy. Some analysts warn of a speculative bubble similar to the one that ended the dot-com era. They argue that valuations in artificial intelligence companies may have moved far ahead of realistic earnings projections. Others take a more moderate view and describe the situation as a healthy correction, rather than the start of a collapse. A short period of falling prices does not automatically signal the end of a long-term trend. Recent data show that forward price-to-earnings ratios of major technology indices have declined from levels above 30 to the mid-20s. Valuations remain elevated, but they are no longer at extreme peaks. This suggests that markets may be adjusting expectations, rather than abandoning the sector entirely. Across the Atlantic and in Europe, stock markets have maintained a relatively stable trend. In some cases, they have even recorded gains. The main supporting factor is the expectation of further monetary easing. In the United Kingdom, investors increasingly anticipated an interest rate cut by the Bank of England. Reports indicated that 4 out of 9 members of the Monetary Policy Committee had called for a rate cut at the February meeting. This strengthened expectations that borrowing costs may soon decline. By the end of the week, the Financial Times Stock Exchange 100 index reached record levels. Investors reacted positively to the prospect of economic relief and improved purchasing power. In broader Europe, the STOXX 600 index remained close to historical highs. Earlier gains had been supported by strong banking performance and comparatively attractive valuations. This positive sentiment was also reflected in Central European markets. However, exchanges in Prague, Warsaw, and Budapest are smaller and more sensitive to foreign investor sentiment. When optimism fades in Western Europe or in the United States, these markets often experience faster profit-taking and increased volatility. Nevertheless, regional indices recorded modest gains during this period. This was supported by improving inflation data and continued economic stabilization, including lower energy prices that benefit households and businesses. Trade policy in the United States has also drawn attention. In mid-February, the Supreme Court of the United States limited the executive branch's authority to impose tariffs unilaterally. The removal of certain protectionist measures was interpreted by markets as a signal of greater predictability in trade policy. Trade associations and companies expressed relief, arguing that the decision restored more consistent and legally grounded trade practices. Reduced uncertainty in international trade relations improved investor confidence. Major European exchanges responded positively as hopes increased for smoother global trade flows and lower geopolitical tension. At the same time, government bond yields have moved in response to inflation data and central bank communication. When inflation exceeds expectations, investors demand higher yields to compensate for inflation risk. When inflation slows, yields tend to decline. Recently, yields on 10-year United States Treasury bonds fell as investors anticipated that the Federal Reserve may eventually move toward easing monetary policy. Bond markets often react more quickly than equity markets to macroeconomic signals. As expectations shift toward lower interest rates, bond prices rise and yields fall. In this way, the bond market acts as a sensitive barometer of economic expectations. Rising yields can indicate concern about persistent inflation or delayed policy easing. Falling yields may suggest expectations of economic cooling and future rate cuts. Sector trends are also evolving rapidly. Financial technology companies are undergoing gradual professionalization. Increasingly, experienced managers from traditional banking institutions are joining startup leadership teams. This shift reflects the need for stronger risk management, regulatory compliance, and operational discipline as these companies grow and scale. A similar development is visible in the insurance sector. Providers have introduced new products designed to protect household income, including insurance against job loss or long-term inability to work. For example, Airbank in the Czech Republic introduced income loss insurance that covers situations such as unemployment or extended illness. These products allow clients to receive temporary monthly payments that can cover loan repayments or everyday expenses during periods without income. This development reflects growing awareness of economic uncertainty among households. Central European markets have benefited from broader European optimism. However, they remain sensitive to global capital flows. Because a significant share of investment in the region comes from abroad, even modest shifts in global sentiment can trigger larger movements locally. Growth phases can be strong, but reversals can also be sharp and volatile. Overall, the current financial environment can be described as a period of reassessment. Technology stocks have corrected, volatility has increased, and discussions about valuation risks have intensified. At the same time, Europe shows cautious optimism, driven by expectations of monetary easing. Structural changes in financial technology and insurance reflect adaptation to a more uncertain world. Global markets are balancing between optimism and caution. Inflation trends, central bank decisions, trade policy. Developments and investor psychology will determine the next phase. Interest rates, volatility, and structural transformation in finance will all play crucial roles in shaping future market direction. If you enjoyed this video and would like to see more similar content, visit our Interesting World channel and subscribe for the latest updates. We look forward to seeing you in the next video.